Welcome to a presentation about one of the most important and most misunderstood relationships in personal finance, the relationship between you, your savings, and your bank. Most people deposit their money, trust their financial institution, and rarely ask whether the interest rate they are receiving is truly competitive. At the same time, financial institutions use deposits as part of a much larger business model that includes making loans, issuing credit cards, collecting fees, and earning interest. This presentation is not intended to suggest that every bank is dishonest or that every banking product is unfair. It is intended to expose a costly problem. Millions of customers may be accepting extremely low returns simply because they have never been shown how to compare their options. They've never learned the rule of 72 or how money really works. When you deposit money into a bank, that money becomes part of the institution's funding base. Banks do not generally store every deposited dollar in a vault and leave it untouched. They operate businesses that use deposits, capital, wholesale funding, and other resources to support loans, investments, payment services, and additional financial activities. The bank needs customers' deposits. Your savings provide value. The question is whether your savings account is providing enough value to you. Here is the disconnect that frustrates so many consumers. A saver may discover that an older or less competitive deposit account is paying very little. Meanwhile, the same consumer can encounter credit card offers carrying APRs near 28%. Federal Reserve data released July 8, 2026 reported an average credit card APR of 20.94% across all accounts and 22.15% for accounts that were assessed interest in May 2026. The Consumer Financial Protection Bureau reported that during 2024, average APRs reached 25.2% for general purpose credit cards and 31.3% for private label cards. The average APR for newly opened general purpose accounts was 27.5%. That does not mean the entire difference becomes profit. Banks must cover defaults, operations, fraud, compliance, servicing, technology, reserves, and other expenses. But it does demonstrate why consumers should pay close attention to both sides of the financial equation. The strongest consumer reaction is often emotional. People feel frustrated because they worked hard to save the money. They feel disappointed because they trusted a familiar institution. They feel ignored because the bank may not proactively tell them when a more competitive product is available. They feel a sense of injustice when they compare the interest being credited to their savings with the interest charged on certain debts. Those feelings are real, even though every account, institution, and financial circumstance is different. Most customers do not wake up each morning and compare savings rates. They are busy working, raising families, operating businesses, paying bills, and preparing for retirement. That creates inertia. An account opened many years ago may continue operating in the background, even when the rates are no longer competitive. The customer may assume the bank will automatically provide its best available option. But that assumption can be costly. The responsibility frequently falls on the consumer to ask questions, compare products, and take action. When customers finally see the rate difference, many describe it as unfair. Their concern is understandable. They may have provided years of deposits, paid account fees, maintained balances, used debit cards, taken out loans, and referred family members. Yet, loyalty does not necessarily guarantee the most competitive savings rate. A financial institution is a business. Consumers should therefore evaluate the relationship as a business decision, not solely as a personal relationship built on familiarity. Some customers accuse financial institutions of deceptive practices because they feel important information was hidden, minimized, or never explained clearly. A disclosure may have been legally provided, but a customer can still feel misled if the most important limitations were difficult to notice or understand. A promotional APY may apply only for a limited period. A balance requirement may affect eligibility. A monthly fee may reduce the customer's effective return. The lesson is not that every promotion is deceptive. The lesson is that consumers must read beyond the headline and understand the complete account terms. Loyalty can be admirable, but blind loyalty can become expensive. A bank has little incentive to improve an account that the consumer never questions. Consumers regularly compare insurance premiums, automobile prices, mortgage terms, airline fares, and prescription costs. Why should savings rates be different? Your bank may be familiar, your banker may be friendly, but your savings decision should still be based on measurable value. Consider this simple hypothetical illustration. If $100,000 earned 0.1% for 1 year, it would produce approximately $100 in interest before taxes, assuming no fees or withdrawals. At a hypothetical 4% APY, the same balance could produce approximately $4,000 over 1 year under the same simplified assumptions. That's an approximate difference of $3,900. Rates change, eligibility varies, and no specific APY is guaranteed. But the illustration demonstrates why even a seemingly small percentage difference deserves attention. The real concern is not merely what happens during the first year. Interest can compound. When an account earns less today, there may also be less money available to generate interest tomorrow. The effect depends on the balance, rate, compounding method, taxes, fees, withdrawals, and how long the money remains deposited. This is why rate awareness should not be a one-time event. It should become part of a responsible savings strategy. Please understand this. A banker working for one financial institution generally represents that institution's specific products. The banker is not normally responsible for showing you every competing savings options available across the country. That is an important limitation. You're not necessarily receiving a complete market comparison. You're receiving a presentation of what that particular institution can offer. We here at the High Yield Interest Savings Account Company provides a different experience. Instead of depending on a single institution's product menu, we work to examine available opportunities through a network of more than 140 financial institutions. The objective is not to chase an unrealistic promise. The objective is to help you compare rates, account terms, minimum deposits, accessibility, liquidity, insurance status where available, and other important features. It's just that simple. More choices can lead to a better informed decision. A high advertised APY can attract attention, but the rate is only one part of the decision. An account with a strong headline rate may include conditions that do not fit your needs. You should know whether the rate is variable. You should understand minimal balance rules. You should evaluate fees, access, transfer procedures, withdrawal limitations, and eligibility. You should also verify whether deposits are held at an FDIC insured bank or a federally insured credit union and remain within applicable coverage limits. Our role is to help you examine the complete picture. Hello, my name is Stephen L. Hodge. My objective is to help consumers become more informed, more confident, and more intentional about where they place their savings. I do not believe you should move money based on pressure, fear, or a spectacular headline alone. I believe you should compare your current APY with available alternatives. Review the complete terms, ask questions, and decide whether a different option better serves your financial goals. The final decision belongs to you. Our process is straightforward. First, we learn about your savings goals. Second, we help you understand what your current account is providing. Third, we examine available alternatives. Fourth, we review the details, not merely the headline APY. Finally, you decide whether any available option is appropriate. Let me be clear. You're never under any obligation to make a change simply because you requested a comparison. This service is designed for people who are serious about protecting and improving the productivity of their savings. It may be especially valuable for retirees, families, professionals, business owners, prospective home buyers, CD owners, and consumers maintaining substantial cash balances. A high yield savings account is not a replacement for every investment or financial strategy. It may, however, provide an appropriate place for money that requires liquidity, stability, or limited exposure to market volatility depending on the customer's circumstances. Doing nothing may feel safe because it requires no immediate action, but doing nothing is still a financial decision. If your account is competitive, a comparison may confirm that you are already well positioned. However, if it is not competitive, the comparison may reveal opportunities you did not know existed. Either outcome provides valuable information. You have nothing to gain from remaining uninformed. If you are serious about improving your APY, the next step is simple. Leave your name, email address, and phone number. I will contact you to learn about your savings goals, review your current situation, and examine potentially competitive options available through our network of more than 140 participating financial institutions. There is no obligation to change accounts. There is no reason to remain uninformed. Your money worked hard to get you there. Now make sure it is working as effectively as possible for you. Complete the form and press Compare My Savings Options now to get started.